Okay, members, it is May 19th. This is the report for the 17th, and we have a situation that we haven't had all year long, and that is we had losses again last week, right, across the board on the indexes. Russell was the biggest hit and has been the weakest, as we know, but we haven't seen two down weeks since the beginning of this year. Matter of fact, since the middle of December. That takes the gains down to something a little less than we've seen recently. Gold only one negative on the year. The bonds, junk bonds, still pushing 7%, 6.5% on the year. We did see a little selling there. We don't really have any kind of event yet in those, but we will take a quick look at them. Safety, TLT, right? Treasuries. That's where the money keeps flowing. Has been, continues to be. In any situation that we see where there is some concern, right, in the market, which of course we haven't seen much of that so far this year. Another big thing that's happening is the dollar. Dollar has continued to push up and has done a retest and regenerate bullish to the upside. I think that's going to cause some problems. Even though it won't be an issue immediately, I think that dollar-denominated debt is going to be a problem for those countries that are extended in being able to pay back that debt as the dollar gets stronger. I think that's an issue. So let's kind of review the technical picture here in what we have and what's going on. So, last week we listed three potential scenarios, things that could happen. And it turned out that the one that we thought that was the most likely case did start to play out, and that is that we saw that case, where we got the regenerate, the weekly bullish retest regenerate failure, right, to get us pushing down, and we started that move to the downside. We talked about a 27.98, 28.03 area, and if you look at what happened last week, we ended up pushing right to that area we were talking about. So the push down last week takes us down to 28.01, and so right in the middle of that zone, worst case, or that scenario that we thought was the most likely scenario. And so even though it didn't play out the way we expected, we thought we'd get a little bit more continuation and then some sort of a drop. It just dropped on Monday, hit the target, right, and then the rest of the week tried to push up. Now, the problem is that on that push back up, you left these long tails up here, and especially on Friday. That's not a good scenario, right? Long tails, always tell you, long tails to the top, either to the bottom or the top. They tell you that wherever price opened, right, or actually in this case it opened here, pushed up, and then closed down here. So they couldn't hold it, right? They couldn't hold price. And if you look at it on the very following day, you had exactly the same thing where you open at the bottom, right, push all the way up, and then in this case you actually close it at the bottom, leave a doji. So it's an equivalent. Buyers and sellers were equivalently excited or disengaged, whichever way you want to look at it. But essentially you close where you open, and it's indecision, right? Don't know what to do. And so the scenario that we had was the push down, hit that target just like we were talking about. That failed bounce now, right? This past week, that failed bounce gives us that situation, right, where we could get some sort of a weekly bounce. So let's look at the weekly chart and see what it looks like. And what we're going to see there is an extension of those losses. So last week losses here, this past week there, as we push back down. Now notice what's happening. You're coming back into a bullish retest regen. That's this area here. We've already tested it once. In other words, the breakout was here, there was the push and the test, then the regenerate. Now we're coming back. This is the second one. That tells us two things. First, it tells us that we actually have a lower probability of actually holding this time. And so when you look at it from that perspective, that says, oh, well, the probabilities are not greater than 50 anymore. They're not in the 60, 70%. They're down in the low 40s, 43 or whatever. The other thing it tells you is that usually on the second test, right, if you come back within 6 bars on the first one, you can do the same thing, is you should trade to the bottom third, and that bottom third's down in this area. And so this push should see farther extension right before it tries and bounces, if it's going to bounce, or it just simply fails. And so those are both scenarios. Given how bullish this is more than likely you don't fail, even though the probabilities are slightly against you, just because of the strength that's been exhibited, and because this is where you had the consolidation last time. But that says 2700, right? In that 2700 area, actually just above it, about 2715 is the low, 2717.94, so 2718. So anyway, somewhere down in that 2730 to 2720, 2719, 18 area on the weekly. Those are the things that we should expect, right? This opens up that test. Remember, we can still be in a bull market even if we push down this far. And I know, that's another 3%, 4% from where we're at. I know that, it doesn't feel that way, but a push down in that area would get us there. Now, if we look at it on the daily chart, actually, let me go back and just finish that thought. If you come back, right, let's just draw the level in. If we come back and we test to the bottom of this area, or even into this area here, right, and we close somewhere in this area, right, that's still on the way up from here to there. That's still just about a third retrace, right? Another third would be down in here somewhere, and then the final. That's still bullish, right? You're still at 66% basically. And so, that's normal. That is what happens, right? And that would be nothing more than some sort of a range setup, in this area. And so, you can't get bearish and say, oh, well, we're going to the bottoms again, because it's way too soon to think that. At the same time, you have to recognize that, it can trade back here. And for a money management risk perspective, you have to decide, how you want to tackle that. Do you just simply hold and be strong and expect it to come back? That's always the most dangerous case, but it's always the most rewarding case if in fact it does it, which it's done for a decade. And so, like this V-shape back up this last time, anybody that sold out and didn't jump back in, they actually lost out, right? You V-shape it straight back up. We've seen that so many times. So now you're going to pull back, right? What's to say it can't do it again? And so again, don't get that bearish just because of this pullback. A pullback into that 2700 area still, in my opinion, would be bullish. We now have the topside tails that I already talked about on the daily. Those recent lows, they would put a bearish ABCD into place. We talked about this. The numbers have changed a little bit, and I got the numbers in there for you. We talked about this scenario, right, where you come up, you hit an ABCD, and then you extend on down. And that extension down, lo and behold, takes you to about the same place we were just talking about on the weekly. And so they both match up. So in other words, if we in fact do continue down without making any higher high here, those projections, if we break under the ABCD and actualize it, the B point, then they're going to project us down to that same area that we're talking about in the low 2700s. So that's these notes here. All this negative stuff is happening, right, in the context of what's been a very strong market. And so again, I want to re-emphasize, don't get so bearish, right? We did get a failure on that first daily bearish retest regen on the daily chart. So if I go back to the S&P 500, the first bearish on after the push down, the first bearish one was right here, right? We got over it. That's a quote-unquote bullish thing, right? You weren't able to regenerate it at the lower level. The only one that did regenerate the lower level was the Russell. The Russell has been the weakest one. And so if you pop the Russell up and look at it, you can see that it came into that same area. This is the swing point low. There's the test. What does it do? It gets right to the top of it. Actually got over it. failed though, closed just up underneath it, and so was unable to regenerate higher. This is the weakest one. Has the same structure though. This one projects about 4%. S&P projects about, actually this one it projects almost the same. The NDX and the NASDAQ are the ones that project the more to the downside. But they've all got the same looking setup. This just happens to be the weakest one. But we did get over on the daily the bearish retest regen, which says more than likely what was down is probably sideways. And so that suggests that even if we do push lower, we're probably not going to cave in, right? Maybe we get a push down, maybe we get a new low on that B point. Maybe we don't. Maybe we hold here. The whole thing is that the odds, even though they look negative at this point, we do have some positives on the board, which is the reason that we are emphasizing it here. The 200-point pullback at a race of third that we just talked about, I don't think you can think the sky's falling, right? If we work lower and we hold, people tend to get too negative or too positive. And we really have to try to control our emotions and recognize that in the big scope of things, this is a normal correction on a weekly or monthly chart. It looks terrible on the daily. The daily is what we always feel, but always trying to look out a little bit farther. What we should be thinking about is adding inventory, right? If this thing does come down to that 2,700 number we're talking about. We should also recognize, right, in this current environment, just one tweet can turn this thing. I mean, that's essentially what happened on Monday with the gap down. You got a tweet on Sunday, or actually the Chinese, the week before we got the tweet that Trump was going to do his thing with the Chinese tariffs. This past week the Chinese retaliated. All this stuff happens. You can get a stick save at any point here, primarily from the political side or the Fed. You got 11 speakers, I think, this week, or 11 speeches taking place on the Fed side. The Fed minutes coming out. If they show us that the Fed is leaning towards easing, right? That language looks that way. It can change things fairly fast, so don't get too negative. Outside the S&P, what else is happening? I just talked about NASDAQ index looked pretty much the same. The Russell's the weakest one. We could get another 3 to 4% losses, actually 4 to 5%. That was supposed to be a 5. If we get those ABCDs to the downside. The dollar is another thing I think that we need to think about. If we go back and look at the dollar, we've been watching this for a while, and the dollar's been pushing back into a retest regen, or did push back into a retest regen on the daily, and that retest was on this bar, as well as a lower one, which was over here. And so both of those took place, right? And then it reversed, right? Reversed here, came back, tested again, tested into this one again, reverses. You're back up at this point. You're back up testing to try and break this thing out. And so we have a situation where the dollar trying to break out, both on the daily and the weekly. The weekly isn't a swing point high, but it's trying to push to new highs. And if you go over to the monthly, it's pushing up towards those highs. If this dollar breaks out, it's going to be a real problem for anyone with dollar-denominated debt. Argentina, Turkey, even China. But you have it all over the place. Everybody that issues bonds in dollars, right? Take advantage of the strength, or take advantage of the ability to put out there. A lot of these countries put out dollars. Well, some of them have currencies that are pegged to the dollar, which is why they do it. Others actually took the advantage of saying, oh, well, the treasuries are selling for, a yield of 3%. We can sell ours for 4% and we'll get plenty of buyers. And that's what they did. Problem is you got to pay it back in dollars. And if the dollar keeps going up, that gets harder and harder to do against a foreign country. The speculative debt, if we look at that, and so this dollar, even though it's not a major problem now, if that dollar does take off, I think it's going to be an issue, and I think it's something we have to look at. If you look at the debt, though, if I go to the junk bonds or the high yield bonds, you can see that these things have come back doing a full retest regen on their daily time frame, so they're back into this swing point high. It's a wide one. It went down and failed. Right now they're bouncing. This says that probably, what was up is more than likely sideways. In this case, that sideways has already taken place, right? We're already negative on these charts, but it's basically saying there's some big range probably going to take place up here at best. And if we look at the other ones, the high quality, if we go to the other side of the picture, you can see how they're holding up. So I don't see any kind of a dead event taking place, at least not at this time. It could get worse. And then we also, if you flip over and look at the TLT is going up to test the highs. And so you're getting close to a test of the highs here and on the weekly. If this breaks out, that could also stir the markets again, right? Thinking that the bonds know what they're talking about, which they usually do. And but I think a lot of this is driven as a result lately, as a result of the weakness in the market that we haven't seen all year. So I don't see the dead event yet. What I do see is other things like some of the key sectors that are having problems, in particular the chips. Usually chips are a good measure of the speculative nature of what's happening out there. These things came off 12% straight away the last 2.5, 3 weeks. They're doing a bullish retest regen 2. They need to hold right here, right now, if in fact they're going to be able to turn this back to the upside. Looks pretty negative here on the daily. If you put it on a weekly, it doesn't look nearly as bad, just coming back into a retest regen. So you would expect them to find a way to hold. Do recognize some of the volume started coming out of this thing last week. So in my opinion, this is a fairly negative situation. The other thing that's negative is the fact that these others are positive. If we look at the real estate market, right, pushing up the new highs, the utilities pushing up to the highs, the consumer durables pushing up to the highs, all of that is a flight to safety. We're moving out of the speculative into the safer stuff. That's what typically happens. That's rotation. That's actually good, unless it gets carried away, right, and everything else craters. We don't have that cratering yet, but we have all these things that are broken out coming back to do retest regens. And one example is the XLK. You can see it here. This has been the leader. Comes back, does a full one, bounces. Is it going to come back and actually break? And that's what will lead to the lower numbers if we start seeing those sectors break down. So what's the bottom line? In my opinion, it is, last week we were watching to see how that first bounce worked. It didn't work at all. Just slammed back down the other side. I always think of this as kind of the cookie jar scenario, right? Where, when I was growing up, we had a cookie jar, and Mom had all these nice cookies sitting in here, and I loved to get these cookies. And I would come and stick my hand in there to grab them, right? And the next thing I know is my mom sitting over here would notice me, and the first thing she'd do is turn around and slap my hand and say, "You can't have those." And that happened enough, I quit sticking my hand in there. Well, that's what happens in the market. You slap the buyers, right? The buyers have been so eager that any small retrace, they jump on it. Any small, and this has been going on for 4 months. Now we actually have a case where they have had their hands slapped last week. Just as I said on that Friday, it looked like we were going to try to get that first bounce. Then we gapped down. That was a hand slap, right? That slapped their hands real nice and hard. And if this rolls over that we're looking at now, that's another hand slap, right? Again, those that hold have been right for a decade. They just hold through everything and everything works out. One day that's not going to work. It's a little early to even suggest that might be the case now, but this is definitely a hand slap. And when you have a hand slap, you tend to get that thing that George Soros talked about, which is where you get the feedback loop trying to push you lower. And so we'll see this week if they can get that push to that 2,700 area. It's going to be hard to do, but that's actually what they're thinking about. Fundamentals last week. If you had to pick one thing you wanted to tweet last week, and you being Trump, you picked the right one, right? Consumer sentiment, 15-year high. That was the only tweet I saw in the economic numbers. It was a good choice, right? Cherry picking at best, because every number that came out last week, with the exception of the sentiment number, was worse than you would expect. Every one of them. Just, retail sales, industrial production, the flash GDPs, the industrial angina, the EZ European zone industrial production. Just go down the list. Leading indicators and business inflation expectation. Every one of them worse than expected. Numbers were supposed to get better in the second quarter, not worse. They're not doing it so far. We don't have much this week. Got 11 speeches this week from the speakers. The FOMC meeting minutes will be the most important ones. So kind of a dearth of economic data. I think it's going to be hard to turn this market unless you get something positive. It looks to me like it's got to be political or those Fed speeches that do it. So here's my expectations for the coming week. Last week, I kind of split it last week and said, you know what, it's about half, worst case half, most likely scenario given the way it turned out. My expectation is this market gaps down, tries to push back up during the week, and then ends up a little bit down on the week. That'd be 3 in a week. I mean, 3 in a row. We haven't seen that. We haven't even seen 2. This was the first time we saw 2. But there's an outside chance that this market could rally back up. And I think getting back up to about the 29 is about as good as it's going to get. Worst case, push down and touch these swing point lows, in my opinion, would be worst case, down in that 2700, maybe 2775 or so area. Folks, that's it for this week. We're finally getting what I think is a two-sided market. And for me, that's actually good. I perform a lot better in a two-sided market than I do in a market that's straight up and a market that's straight down. Both are hard to handle because I tend to want to counter-trend trade. I want to retrace trade. And so retraces to me happen best when you have some sort of a sideways market. So if I can pick a range, and I have a range from here to here, I can pick those retraces into areas and say, okay, I can short. Or I can pick those retraces into areas like here and say, okay, I can buy because I know the probabilities. When the market goes straight up, it gets harder and harder. The air gets thinner and thinner. It gets harder and harder to just stay with it. Same thing on the way down. Retraces typically, or what happened in markets, happens 60 to 80% of the time. Even the first ones, if they last more than 6 bars, it's even better. Those are the meat of what happens in the markets, not breakouts that just keep going and going and going. Looks like we're going to get that. That's a good thing in my opinion. And I think for the market, it's a good thing that this market is going to settle into some sort of a range probably. Have yourself a good one. I'll see you next time. Take care.